Hey guys, so today it's going to be an unconventional video because it doesn't really have anything to do with law. However, this is a topic that I find really interesting. I really love stocks and I would love posting more videos about it. It's a big passion of mine, and this is definitely not financial advice, but I thought I could explain some educational ideas and definitely make you guys a better trader by talking about certain concepts. So today I thought we would address the question of whether or not to margin or not to margin. That's the question of today. So first, I thought I would explain to you guys what exactly it means to be a margin trader or to trade stocks on margin. So first, you have two options. You could either buy stocks with cash, which is you put that in $100 and then you could buy $100 worth of stock. Or you could borrow money from the bank to buy stock and you use your own money as collateral. It might sound as a weird concept, but you could put $100 in and the bank would loan you $100. Your $100 would be collateral and you could buy $200 worth of stock. However, in this scenario, your $100 would be the first to lose. So if your stock goes to $50, if the $200 worth of stock becomes $100, you would lose all of your money. So that's the case. I'm going to bring you an example here. So let's suppose we take the example of Shopify. Shopify, when I took the screenshot, was trading at $34.10. Let's say you put in $5,000 into a margin account. The bank would loan you another $5,000. So now you would be able to buy $10,000 worth of stock. So you would be able to purchase 293 shares of stock, and you would have $5,000 of it would be yours, and 5,000 of it would be the bank's. So now let's see what would happen if something happens. So first, what could happen is the price falls. If the price of the stock falls, your $10,000 worth of stock becomes worth $7,000. Your margin equity would always remain the $5,000. However, your stock would only be worth now. If your $10,000 stock became only worth $7,000, you would lose $3,000, and you would only own $2,000 of value. And chances are the brokerage would call you up and tell you that you need to put more money into your account. Let's say that $10,000 completely falls apart and becomes worth $0. You would owe the bank $5,000. On the other case, let's say your price grows of the stock. So your $10,000 investment that you put grows by 25%. So now it's worth $12,500. Your margin that you bought, the value is wrong here, but it would be $5,000 that you borrowed, and your equity would be $7,500. So instead of a 25% gain, you would be getting a 50% gain, which is tremendous. All of your equity would grow by double the percentage. So now we're going to get into the pros and cons of margin trading. So now you guys understand that it's borrowing money from a bank to use for trading. It's risky, obviously. So the first pro is that you get more bang for your buck. You could buy way more stock. You can make a bigger splash in a company if you want to buy more. Your profits are going to grow a lot faster. And all of your percent increases are going to be doubled so let's say you make a 25% profit, it's going to become a 50% profit if you sell your stock. The cons of it is that it's going to be much riskier, and you have the potential to lose way more than you own. The bank could be calling you up and telling you that you need to deposit more money because you lost all their money. Some brokerages have a setting where you can only lose what you own, and then they'll sell you out and you'll be left with nothing. And lastly, all of your percent losses are going to be doubled, frankly. So it's high reward, high risk. So we're going to talk about the question now, should you margin or not? So it depends on these four aspects that I thought of. There could be more. The first one is how disciplined you are. If you're going to be happy taking a 10% profit on your trade, I think it's a good idea for you to be margining your assets, because once you hit that percentage point, you're going to be disciplined, you're going to take your profits, and it's going to go a long way. But you need to stay disciplined. And if you're not disciplined, you are not going to be able to trade margin. It's going to be bad. However, let's say you're very high risk tolerant. If you don't mind losing all of your money in the stock market, but you want to have the potential to make a ton of money, it also might be a good idea for you to go on margin. However, this is up to you, and you need to really be honest with yourself in those two regards. Next, you need to look at your other assets. If you have $50,000 and it's all you have to your name, it's probably not wise to margin it, because you're going to be out $50,000 if you get a margin call. However, let's say you own $10 million worth of assets and you want to margin $50,000 in order to grow your profits and your assets quicker. I think it might be a good idea. And lastly, are you using option trading strategies in order to protect yourself on the downside? if you're a wise investor and you know a lot of different option strategies such as covered calls or using call spreads and different things to mitigate your losses or buying puts, uh, it might be a good idea. I'm not advocating for it. I think it's all dependent on you. And if you want to take that big leap, it's a big gap. If you want to use margin, it's dangerous, but keep in mind these four aspects. And I think it could make sense to the right investor. And I hope you guys enjoyed this video. If you did, make sure you hit a like, subscribe.